Welcome to the 7th lecture of Unit 2 in the Ethan Trades Mentorship. In this lecture, I will be explaining what impulse structure is and how we use it in combination of range structure to find institutional structure. Previously, you have learned range structure by using price legs in the market as premium and discount. And now, as you know displacement from the previous lecture, we can blend both understandings to look for ranges created by displacement. This is known as impulse structure. Impulse structure is the exact same as displacement, but now we use it in context of market structure. Impulse structure is the price leg that creates a clear one-directional expansion in the market. It will look like a series of large candle bodies in the market, just like displacement. Just like displacement, when it creates, you cannot miss spotting it because it's so blatantly obvious that the market is moving in one direction or shifting in the other. Impulse structure is paramount to trading because it is our immediate bias builder. When we see it, we automatically understand where the market is trying to reach for. Although applicable to any form of displacement in the market, we typically want to wait for a market structure shift or break of structure to occur with displacement to give us high conviction of a trade idea. So when using impulse structure, we want to see that impulse structure create a market structure shift or a break of structure to be high probability. In this visual, you can see that the range is anchored from the low that creates displacement and the high that finishes displacement, rather than the strong low within the previous range. So previously, you have learned that in range structure, we'll use this low right here because this is the strong low within the previous range. However, now we're learning with impulse structure, it's the low that creates displacement, right? Displacement past this previous range high, creating that break of structure, that continuation. And so we have displacement past that high. So we're looking at the low that creates that displacement and the high that finishes that displacement. And we use that as a range. And vice versa, in this slide, I've created a schematic of a bearish impulse structure. On the left is a line chart. And once again, on the right is a candlestick chart. In this visual, you can see that the range is anchored from the high that creates displacement and the low that finishes displacement, rather than the strong high within the previous range. And so once again, here in range structure, we would have used this high because that's a strong high within the previous range. But here we can see it's creating a break of structure, so we can focus on this leg specifically. So here, this is the high that creates this displacement lower to this low that finishes displacement, so we can focus on this range. When combining both range and impulse structure together, we get institutional structure. And so range structure often acts as the longer term range price is operating within, and impulse structure acts as the immediate GPS in the market, letting us know where the market is reaching for right now. And so if you look at the diagram right here, this black line is going to be your higher time frame, the blue line being your lower time frame. And so if you look in context, and this is what we're talking about in the premium and discount lecture, is that when you stack your time frames to determine whether you're in deep discount or deep premium, this is how you can do it. So on the higher time frame, we understand we're inside of this large range. However, once we start creating that lower time frame market structure shift with an impulse, so that would be impulse structure creating a market structure shift, that's high probability. And so we look for that impulse as a sign that price is now on the higher time frame reaching for a discount within this larger range. And so once that impulse structure occurs, we wait for either a consolidation or retracement. In this case, it's that AMD schematic, right? Accumulation with this consolidation, manipulation of these highs, and then pushing lower. And so once we push into a discount, we wait for the next market structure shift with impulse behavior. And so here on this next market structure shift right here, we can see we get a large impulse structure above this previous strong high once again, creating that market structure shift, right? And so once that happens, we draw this range once again for that impulse structure, wait for accumulation or retracement. In this case, I've drawn out another AMD schematic, so accumulation with this consolidation, manipulation lower into that discount, and then buying into this final objective up here of the higher time frame range high. And then vice versa, you have the bearish example, of course. Your black line is your higher time frame once again, blue line being the lower time frame. So here we can identify that we have this higher time frame range, and on the lower time frame, we start dissecting price based on market structure in alignment of our higher time frame, right? So we understand that our higher time frame is in discount, but when is it confirmed that we're reaching for premium with high conviction is when we have that impulse structure creating that market structure shift. Once that occurs, once again, looking for that accumulation or retracement after expansion, right? So here I drew out that AMD schematic once again. So accumulation, manipulation, distribution. And so this distribution right here, same as on the bullish side, or sorry, on the left side, this left schematic here, you have a accumulation, manipulation, distribution, the distribution being the impulse structure itself. Draw out that range until we get a clear market structure shift with another impulse structure. Then we could look for continuation. And so from here, once we trade in that discount, you look for continuation targeting this lower time frame range high. And then once you are in alignment of the higher time frame, once again, you can start targeting that higher time frame external low or that extreme low of the higher time frame range for that continuation of the high time frame move. And so here you can identify that you are at a premium in the higher time frame range, and you're also at a premium on the lower time frame range, right? We create this impulse structure here, creating market structure shift, draw out this range, wait for either consolidation or retracement. Here I drew another AMD schematic, so accumulation, manipulation into premium of the lower time frame that we identified occurred from the premium of the higher time frame, right? So it's stacking confluences now and looking for lower prices. When your higher time frame and your lower time frames are in alignment of each other, that is the highest probability opportunities you will find because price will just straight up run in your favor. And so if you ever look at the market and just see like big candles expanding one direction, that's because those candles are in alignment of the higher time frame. So in this quick segment here, I wanted to show you guys how I personally like to use impulse structure. And that's pretty much using impulse structure on the higher time frame to identify what the range of my lower time frame structure is. And so what I would usually do is, let me put a vertical line here, just delineate a point in time that we focus on. So anything from the right side of this chart, I'm paying attention to. Anything to the left side, I'm ignoring it. And so if we were looking at price like this, then we can pay attention to the first impulse in price. Well, here we see this large down close candle that creates a market structure shift right here. And this is a market structure shift because it's a swing low. So let me just show you. That is a swing low. It's just a very, very small swing low. And so this would be that first sign of a market structure shift because you have displacement, creating that impulse structure, creating that market structure shift. Now, if you wanted to be safer, then you could have just waited for this low over here where we clearly traded back into the range of this previous range. Here. Actually, you know what? I'm just going to move this line back a little bit so you can pay attention to this range. Okay, so we trade into the discount, right? So now that we're in discount, we failed to push past this previous range high. And so this is the earliest sign of a market structure shift. If you want to wait for the traditional kind of market structure shift, then you would wait for this low. But either way, the same thing is applicable. So if we were to follow the traditional way of doing it, then we'll just look at this market structure shift right here for now, just for simplicity's sake. And so we would be paying attention to the next impulse range. So this high over here is responsible for pushing price all the way down to this low, right? And so we can pay attention to this range specifically from this high to this low, because if you pay attention to candle bodies, it just pushes price straight down, right? And so that's what we're looking for. That creates the market structure shift. So from here, we would draw our new range from this high to this low, and you would be able to dissect this on a lower time frame, right? So if this was my daily chart, then I would go to either a 4-hour or a 1-hour chart. Once I'm on my 1-hour chart, I can now understand that this is the range that we are operating within, right? So I'm looking for price. If we get clear confirmation that prices wants to go higher, I understand that it's reaching for a premium. And then after it reaches a premium, we're looking for opportunities to sell for this continuation lower. And so that's using the context of the higher time frame impulse structure, turning it into our lower time frame range. And now I'm looking for lower time frame market structure to be in alignment of my higher time frame. And so here you can look once again for your market structure, right? So let's say you get your market structure shift over here, this high right here. And I wouldn't really count a market structure shift until you get a body closure or impulse structure, remember. So that would be the impulse structure that creates the market structure shift is what you want to look for. And so once we create that impulse structure that creates that market structure shift, you can confirm this as a market structure shift on the lower time frame. So I'll just put a lower time frame market structure shift. And so now that we're incorporating this range structure, right, derived from the higher time frame impulse structure. I know it's a little confusing, but just give it some time and I promise you'll understand it, because this is pretty subjective as well. This is the portion of price action where I don't like, because it is a lot more subjective. But don't worry, as we progress in this mentorship, there's so many confluences that you're going to understand that you're going to become so good at spotting these things. Right now, I haven't even mentioned 10% of everything we use. So I think that you will be completely fine. Even if you don't understand this right now, in the future, you will understand this. And so going back to the lesson here, with this lower time frame impulse structure creating this market structure shift right here, right? So we can look at this range here. Now make this green so that you know this is the lower time frame impulse structure, right? Just like in that schematic that we drew earlier. We have this impulse structure here. This high creates this down move of this entire breakout structure right here. Or if you want, you can even use this high right here. Either one is fine. But the important part is that you have displacement past these points in price, these key levels in price, to signify that price is continuing in the direction. So here you have your lower time frame market structure shift from this impulse structure. So this low is responsible for this push higher, creates this high, right? And from that, you are looking for this new range to buy. So here, I'm not going to put a template. So this is the lower time frame range. Once you form that, you can even drop down to a lower time frame if you want. And that's where you'll start finding that top-down analysis is very high probability. From here, once you have this impulse structure, trade back into a discount, then you can look for buy opportunities once again. And so this is also going to be a good opportunity to show you guys when to disregard a impulse structure. Is you want to see a clean sweep on liquidity. So let's talk about this next impulse structure. So here you have this low that impulsively pushes to the upside. So you have this low to this high. That's your range right here. Well, you can see that the market fails to trade back into a discount and impulses higher again. That's when I would start to disregard impulse structure. And this, once again, is 100% discretionary. It's gonna definitely take some experience in the market. But something I like to use is if you don't trade back into 50% of a range, then I like to just trail price. And so this next impulse, this will become your range structure rather than impulse structure. And that's when I would refer to a range structure. And so here you can see that we trade back into a discount. This low is referred to as liquidity. So it's a liquidity sweep. You will be learning this in Unit 2C. Once we trade back into this low, and then we have an area of interest here, which you will be learning in Unit 2B. So I just want to get you guys familiar with market structure shift, but just know that there's a reason why price trade back to here and then continue higher. Is because one, there's a liquidity pool here, and two, there's an area of interest here. This is called the fair value gap. This is called liquidity pool, sell side liquidity. But just understand that this is what makes my decision in the live market more informed, is because I understand that there's two key levels right here that needed to be touched or taken out before we see a continuation in price. So for now, I just want you guys to focus on this here, where if you have an impulse here, it fails to trade back into the 50% level or into a discount, then you just continue trailing price higher. And you can see that now you have a liquidity pool or area of interest resting at that discount level, which is why price continues to go higher. And so from here, once again, what is the impulse structure here, right? Still in context of our higher time frame narrative. And so once this occurs, this is where I'm looking for higher prices. So once again, this low over here creates this impulse higher to this high over here. So that's pretty much what my eye instantly sees. At the time, if this was playing back live, then you would most likely see something like this. So you'll probably see that and you're like, okay, this could potentially be the high. Looking at this range right here. Unfortunately, you were wrong. No, I'm kidding. There's no such thing as being wrong. I mean, you can be wrong, but as long as you manage your risk, that's the important part. But here, we don't trade back into that discount. I would continue trailing my range higher. So this would look like your new high. The next candle, waiting for a discount to buy again. And once we trade up, you realize now that we are in the higher time frame premium, right? So just like that, you had these a few buy opportunities, I guess. So you could have bought from this market structure shift. You could have bought when we trade back into this discount here. And now we understand that we are at a premium. So what would we look for from here? A sell opportunity in confluence of the higher time frame. So now we're looking for our lower time frame structure to tell us that we are going lower within this higher time frame range. And so from here, playing it forward, once again, so this high is pretty much where the displacement ends. You can see these large candle bodies higher, right? Pushing, pushing, pushing. This is your range. And so now you're pretty much looking for an opportunity to watch the price create a market structure shift over here with impulse structure because we're in a premium right now. So we're looking for continuation lower. So if we go back to the daily chart, right? Once again, we understand that we're at a premium here, looking for lower prices and targeting this low right here because that is the range low extreme, targeting that and possibly trading through that as well. So you want to pay attention once again on the higher time frame. If we were to trade to this low, do we displace through it or do we just simply trade into a little bit and continue higher? These are very key things. Displacement versus manipulation is very, very key lesson in market structure. If you're able to identify displacement versus manipulation, that alone will carry you through market structure pretty much. So very, very key thing to understand. And so at this point, so on the lower time frame, you understand you're in a premium of the higher time frame range, looking for this low to be taken with displacement. And that would be your traditional market structure shift here, right? And so that's pretty much what you're looking for at this point in time. Once that occurs, looking for that. So you see that this impulse occurs. And so once this market structure shift occurs, I'm going to pay attention to this low. What happens at this low? Are we able to trade through it? In this case, we are able to trade through it. And so our new range that we draw would be from this high that creates this large down move, right? This high causes this large push lower, and we're looking for the low that gets created. At this point in time, we would have seen this low formed, and then we just continue. So I see prices continue lower, so I would just follow price down again. And so I just keep following it. Once this occurs, you're waiting for price to trade back into a premium, looking for a continuation to go lower. And so you would wait for price to go into a premium. Once we get into a premium, that's pretty much where you're looking for your sell. And so I believe in this example, we actually take a loss here if you were to sell. So imagine you did sell here and then you wanted price to go lower. Let's say you put your stop loss up here. In this specific example, you do end up getting stopped out, but this is where it's important, once again, to pay attention to displacement. And so here, this kind of shows the flaw in this market structure logic. However, I need to get this across to you guys so that you guys understand what to look for. So here in price, I want to show you guys, because this displacement lower from this high to this low, you see this large candle body, right? In unit 2B, once again, you'll learn what this is and why it's a sign of reversal. But when you have a large candle like this being inverted, or essentially traded through like it's nothing, that's a sign of reversal in itself. And if you traded candlestick patterns, this would be called an engulfed candle, which means it's such a large down close candle, it gets engulfed by higher prices, right? It's by larger up close candles. And so once that occurs, this is something called the change in state delivery. Once again, don't worry if you don't understand it, because it will all be explained. But just a quick rundown, a change in state delivery is when the market is changing from a sell program. So in this case, market's going lower because it's in a sell program to a buy program. So it's going higher because it's in a buy program again. And so at this point, once you have that conviction of this occurring and you have another market structure shift here pretty much, then you look for premium prices once again. And then it's just rinse and repeat. Once you're at a premium, you want to look for a continuation of the higher time frame, right? So the higher time frame, if you're in a premium, then you're looking for lower prices on the lower time frame. So that would be in context. So once again, at this point, you would be looking for your market structure shift. See when it occurs. So here's your market structure shift right there, right? I'll just draw out the ranges because I don't want to go through every single piece of price action in front of you guys. That would take way too long. However, I just want you guys to know these are like the ranges that you're following along. And so once this range is taken out on the lows, potentially look for lower prices. You would want to wait for this range to trade back into a premium, and then look for lower prices from here. And once again, you want to pay attention. At this range low, are we getting displacement or are we getting manipulation? In this case, at this first time we swept this low, there's large wicks on the bottom. We get that engulfing candle pattern once again. I don't want you guys to get used to that engulfing candle pattern, but it's a good description for now. And so once we have that manipulation, we identify manipulation. What happens at this high? We have another manipulation. Okay, so what happens at this low? We have a displacement lower, right? So this is the importance of displacement versus manipulation and the confluence of ranges aligning with each other. And so I know it might be confusing now, and I promise as you progress in your trading, you won't have this many ranges on your chart. At most, you probably have, let me clean up the chart. At most, when you're actually trading in real time, once you get proficient at using ranges, all you're paying attention to is this right here. And once you become even more proficient after that, is all you'll see is just a naked chart, and you already understand where price is going because your brain is already processing, okay, this is the larger range that we're in right now, and you're paying attention to what price is doing within it right now. And so that's why you'll usually see people drawing just two lines. This is the range we're in between, and this is what price action's happening inside of this range right now. So that's how people determine their ranges pretty much, if you ever watch someone else trade with ranges. But just know, because we're in a premium of the higher time frame range now, right, we can understand that we expect lower prices into the low of this range because we have that market structure shift of the higher time frame that tells us that we're going to go lower. So I'll just let this play out, and eventually I remember, because I traded this live, it just goes down to this low. Once that happens, so I'll just go to daily chart. Once that happens, once again, you're just doing the same thing, the context of the higher time frame, right? And so once that occurs, you have this new range that gets formed that you're paying attention to, or you can just use the impulse structure, which is, once again, this high, this low creates that displacement lower, right? And so you're paying attention to this range right here. Once we trade back into a premium of this range, looking for lower prices on the lower time frame at this low. Once that happens, once again, rinse and repeat. You're drawing this range right here, looking for price at this point to trade into a premium. Once that happens, you're looking for it to trade back into this low here. In this case, this is where the market structure shift occurs, right? So here, you can either use this high or this high. This would be your range structure. This would be your impulse structure because this high is responsible for pushing price past this previous range low. This is your impulse structure. This is your market structure shift right here with another impulse structure. But this is where I was mentioning if you see that price is impulsing and displacing, it's because we're within a higher time frame range. And so if you look at your weekly chart now instead, you'll understand that we're inside of this range. We traded into a discount, and on the weekly time frame, we're looking for the range high. So it's all in context. High card rules. So what that means, higher time frame will always have more say over the lower time frame. But I just kind of want to get that mentality and that ideology. Price is fractal, right? So we're actually inside a weekly bullish run, but the daily was a bearish trend of itself. If we drop down to even 4 hour, within each of those bearish runs, we have bull runs, right? On the 4 hour chart, within each of these, you have even more fractal elements. And so that's the idea I'm trying to get across. And so once again, on the weekly chart, you'll understand that we are reaching for higher prices, right? So I hope this was insightful. And once again, if you don't understand this yet, don't worry too much about it because you will understand it very soon. So that's all for this lecture. And as always, be sure to study this in your own charts because impulse structure will be the basis of the higher time frame analysis within the bread and butter model that I will teach in this mentorship. As always, the homework and quiz for this lecture will be posted in the description below. Don't cheat yourself of this learning opportunity. Study and do the work honestly. I promise your hard work will be rewarded. Your assignment for this lecture is to go into your charts and try to spot how impulse structure guides price within a range structure. So I'll see you guys in the next one, and as always, have a great day.